If you're incorporated and you don't have a basic understanding of notional accounts, you could be paying tens of thousands of dollars in extra taxes. But that's also not your fault. The Income Tax Act makes corporate taxes ridiculously complicated. So if you've ever looked at your corporate tax return and felt like your accountant was speaking a different language with words like CDA, RDTOH, and GRIP, you are not alone. And from what I can see, the internet isn't actually much help with this. So I'm Matt. I'm a retired physician turned flat fee certified financial planner. And my job in this video, my challenge I've given myself, is to explain corporate notional accounts without math in plain English in under 10 minutes. You ready? Okay, let's go. So here's the key. Stop thinking about notional accounts as accounts and start thinking about them as coupons, in particular, tax coupons. There are three: a tax-free coupon, a cash-back coupon, and a low-tax coupon. So to explain how this works, we're going to use our friend, Dr. Alex. Alex is a great physician, but like most of us, he kind of hates tax season. He's looking at his corporate tax return right now, and he sees those acronyms like CDA, RDTOH, and GRIP with balances next to them, maybe $50,000 here, $20,000 there. Not knowing what they mean, Dr. Alex understandably might log into his online banking to see where those accounts even are, but he's not going to find anything. Those accounts don't actually exist in real life. Alex might be a little bit confused. Where is that money anyway? So what you and Alex need to know is that notional accounts aren't actually accounts. These are tools that stop the CRA from double taxing you. They exist because investments and taxes in a corporation have to work differently than investments and taxes at the personal level so that everything balances out once corporate and personal taxes are taken into account. So today we're going to clear up the confusion by looking at these not as bank accounts, but as tax coupons. Every time your corporation pays a specific type of tax or realizes a specific type of investment gain, the CRA hands you a coupon. You can't spend those coupons at the grocery store, but you can use them with the CRA to move cash from your corporation to your personal accounts with more tax efficiency. So let's walk through the big three with Dr. Alex. First up is the CDA, the Capital Dividend Account. This is the tax-free coupon. So let's say Dr. Alex bought some stocks inside of his corporation and he sells them a little while later for a $100,000 profit. Well, that profit is called a capital gain. And in Canada, 50% or half of that gain is taxable. But the other half is a tax-free half, and that gets added to his CDA balance. So essentially, Alex receives a coupon from the CRA, in this example, to take $50,000 out of his corporation completely tax-free. There's actually another way to earn these CDA coupons, which is by donating appreciated securities or investments like ETFs or stocks. Let's say Dr. Alex bought an ETF years ago and it's way up. Instead of selling it and then donating the cash, he could donate the shares directly to a registered charity. He gets to deduct the full value of the donation, pays zero capital gains tax, and here's the really magical part, 100% of that capital gain gets added to his CDA. So if Dr. Alex donated an ETF worth $5,000 that he bought for $2,000, he'd be able to deduct $5,000. He would pay no tax on that $3,000 gain, and he'd receive a CDA coupon that would allow him to take out $3,000 tax-free from his corporation. One really important tip, though, is that to cash in this CDA coupon, your accountant does have to do some work and file something called a special election form. And naturally, there's a cost to that. So don't trigger the CDA for small amounts. A reasonable rule of thumb isn't to wait until the balance gets over about $20,000. Otherwise, the fees are likely going to eat up the tax savings. So next up is the RDTOH account, or the Refundable Dividend Tax on Hand. Now, the fact is that this is actually divided into two parts. There's the non-eligible RDTOH and then the eligible RDTOH, but they work the same way. They just have different numbers. So we're going to discuss them together. You can think of this as your cash back coupon. The RDTOH balance builds up when Dr. Alex's corporation earns passive investment income. So this could be interest from bonds, but it could also be dividends or the taxable half of capital gains. When the corporation earns this passive income, the CRA charges a painfully high upfront tax rate, roughly 50%. But a specific portion of that tax, about 30% of it, is actually refundable to the corporation. The reason it's set up like this is because the CRA wants money flowing out of corporations into the economy. So it holds on to this extra tax as a kind of a security deposit to encourage Dr. Alex to move that money out of his corporation. This creates an RDTOH cashback coupon. When Dr. Alex pays himself a dividend, the CRA validates that coupon and sends that refundable portion of the tax back to his corporation. How much is refunded depends on the size of the dividend, but that's math and we're not going to get into that here. So we're happily going to leave that up to your accountant. The important thing is to know that if Dr. Alex sees a high balance in his RDTOH account, it means that his corporation has overpaid tax and is due for a refund. So adding dividends to his compensation will trigger that refund. And finally, we have the GRIP account, or the General Rate Income Pool. You can think of this as Dr. Alex's low tax coupon. Usually, small businesses like physicians corporations pay a low corporate tax rate on most or all of their active business income. Usually that rate's about 12%, depending on your province. But Dr. Alex will grow a balance in his GRIP account. He'll get a GRIP coupon when, for one reason or another, his corporation is forced to pay the higher general corporate tax rate, which is about 26%. There are three ways that Dr. Alex could generate a balance in his GRIP notional accounts. First of all, if he works really hard and makes more than the small business limit of $500,000 in profit from his practice, then active income above that is going to be taxed at the higher general rate. Second, if Dr. Alex has too much passive income, investment income in his corporation, over $50,000 in a year, the government starts to shrink that small business limit. And the third way is if Dr. Alex received eligible dividends from his investments. In these cases, the corporation pays the high general rate or receives income that's already been taxed at that rate. And to make it fair, the CRA gives him a GRIP coupon. Dr. Alex can then use that coupon to pay himself an eligible dividend, which has a lower tax rate than the usual kind of dividend, which is a non-eligible dividend. That's why GRIP is like a low tax coupon. So here's why all of this matters. If Dr. Alex ignores these coupons, he might be paying personal tax on dividends when he could be using his CDA coupon to take that same money out tax-free. His corporation might have a giant cashback offer in the form of an RDTOH coupon that's just sitting there unused in his corporate statements. Or he might not realize that his GRIP account makes him eligible to pay less tax on money he takes out of his corporation. So the bottom line is that notional accounts are tax coupons. They allow you to extract money from your corporation with lower or maybe even no tax so that you can use it personally. You don't need to know the math. You just need to ask your accountant, do I have a balance in my CDA or RDTOH or GRIP account that I should be using? Now, I totally recognize that this still might sound a little bit complicated and it might not stick right away, and that's totally okay. Bookmark this video and come back to it the next time you see CDA, RDTOH, or GRIP on your corporate statement. But if you did find this helpful, please like the video, maybe subscribe, and send it to a friend so that more doctors can optimize the use of their corporations.